All right, traders, happy Thursday to you. Welcome back to the live room. Welcome back to the Bridging the Gap workshop, day number 3. Hope everyone is doing well. I'm off to a weird start this morning. I just spilled a whole cup of juice like 2 minutes before the room started. So not the start I expected. Yeah, it was. I'm very particular. Like I like my hots hot, I like my colds cold. So I had my juice in the freezer. It was right at that point just before freezing where it was just cold enough, and I'm taking it out and splash everywhere. Everywhere. Ruined my mood. I was all prepared to give you a rant about alligator turtles and walking sharks and things that are growing and developing while no one's looking that are going to destroy us, but not in the mood to talk about alligator sharks or alligator turtles and walking sharks, but you should be aware of those, just like the murder hornets. But I suppose we will just get straight to the markets then. And if you didn't notice, we had a news event out today. Bank of England interest rate hike came out about 30 minutes ago, 7 a.m. New York time. And if you look around the different pound pairs, we are seeing quite the reaction. And I had a conversation this morning with a trader on our chat who was, we were talking about a few things. And he was saying, man, wish I could have caught that. And we got to remember this about news, right? We spoke about news in a few ways, right? From a higher time frame perspective and a lower time frame perspective. A higher time frame perspective, it doesn't really make too much of a difference in the bigger scheme of things. If you are a lower time frame trader, a day trader, you want to avoid this stuff because you can get whipsawed to death. And the particular situation we were talking about was it was a formation on an hourly chart. It was not an advanced pattern formation. We're having a discussion about what made it invalid. And it had looked like it had rallied straight down and would have smashed targets. But in the reality, right? Let me ask you guys this. Has anyone tried to trade during a news event? We'll put it that way. By the way, look at this prediction on our pound yen yesterday, right? 63.50s, boom, right on a dime. We actually tested and probed the 164 level right below it. Psychological numbers, right on a dime. Yeah. So, what is something that happens during news that many people don't talk about, right? We see the reaction, we see the move in our direction, and we always turn into the woulda, coulda, shoulda trader, correct? Good morning, Wiz. Right? We always come, oh, woulda, coulda, shoulda, woulda, coulda, shoulda, right? In reality, what happens during news is that spreads open up. And many times, when you're not trading, it looks like you would have caught that move. In reality, you would have been skunked out because the spreads opened up. Your stops would have been triggered right before price action goes in your intended direction. You get upset because you should be in that trade and you missed it because you were stopped out. So then you try to hop in late. And then as soon as you hop in late, market reverses and goes the opposite direction. So now not only did you lose one way, but you lost the other way. And you become a tennis ball in a tennis match where you're getting beaten back and forth from side to side, always seeming to be late. So you got to be very careful for you guys that are new about trading news events on lower time frames. And I'm not talking about trading before the news event comes out and you've already got your positions established. I'm talking about people that try to be slick and they try to wait for the news event to happen and then they try to enter their trade right away and catch the move or whatnot, or enter late. In my opinion, it is better to just stay away, especially if you are a lower time frame trader, right? The number one rule of trading, and this is another difference between newer and seasoned vets, right? For a lot of newer traders, number one rule of trading is try to make as much money as you can. The number one rule of trading for professionals is what? What would you guys say? Professionals, seasoned vets, experienced traders, however you want to call it, doesn't matter. What's their number one rule? Is it make as much money as possible? Nope. Don't go broke. Conservation of capital, preserve capital, keep the money, says James. That is the number one goal. So we are always risk averse. We are always looking for situations where we have the least amount of risk on the table, because the situations we like is when we have a little risk but still have the chance to make reward, versus we have lots of risk in order to make that reward. So capital preservation. So we're going to start today. We're going to revisit the dollar yen, right? Because I want to go back into some of the concepts that we spoke about yesterday. We touched on it here in the live room yesterday. You guys went off and hopefully watched the training yesterday. In yesterday's training, we talked about routines, right? Setting up a routine, setting up trading around your life. We talked about the if-then syntax. We talked about the IPDE process and essentially developing a trading plan, what goes into a trading plan, and how you need to be mechanical, how you need to be robust in how you approach the market. And I want to do some practical application with that, where we have a real life example. And then dollar yen's a perfect example because this was a trade that's already on the radar. We did get our higher high, higher close, which can be an aggressive entry, but there are still other ways to get involved as well. So we know about the IPDE process already, right? Who can tell me what IPD is? Preferably someone new, someone that's in the workshop. Who can tell me what IPD is? IPDE. What does that stand for? How well have you been listening and looking and watching? James says, identify, predict, decide, execute. It's a simple 4-step process. Feel free if you want to add something to it, whatever, fits your fancy, but it's a nice process to keep you on track. And when we do this IPDE, identify, predict, decide, execute, well done, Boyd. Well done, Daniel. Got to get a little quicker on the keyboard. James is already loaded up and ready. He already knew. We understand that process falls in line with the bigger scheme of our trading plan. And this brings me to another point, right? And this is another thing that gets a lot of traders in trouble. Again, if I were ever to write a book, aside from like the 4 that I started and never finished it, I think it would be called Things That Get Traders into Trouble. It'd be an autobiography because I did all of them. Things that get traders into trouble. My other idea was 50 of the dumbest trading questions I've heard, but I'm too nice and I don't want to offend people. But things that get traders into trouble, one, not being organized. And there's many kind of realms of not being organized, but not being organized in what they're looking at, when they're looking at, and why they're looking at it, right? And one of the biggest components of what they're looking at, that can be different pairs, it could be different markets, right? There needs to be consistency in that. But there also needs to be consistency in what? What else does a trader need to be consistent in when they're analyzing the market? Not just the pairs or the markets or the assets, whatever you want to look at. What else do they need to be consistent in? Their strategy, yep. What else? That is true, not what I'm looking at. Time frame. You need to be consistent in your time frame. Now, be honest for a second. How many of you guys have been time frame bouncers? Meaning where you just go to any time frame randomly until you find what you're looking for. Raise your hand. How many of you guys have ever done that? I'll put my hand in there. I've done it before. I'm not ashamed of it anymore. Yep. Now, we know that the formula of success is consistent analysis plus consistent execution equals consistent results. If you're bouncing around different time frames, and lots of you are lying because only a few people typed it in. Lots of you are lying. If your formula is consistent analysis plus consistent execution equals consistent results, and you're bouncing from random time frame to random time frame, are you consistent? No. You're all over the place. And here's the secret. The hard part about trading, one of the hard parts about trading, is that we can create a trade reason at any point in time. One of my favorite games to play when I speak to traders is give me any chart, any time frame. I bet I can convince you to buy or sell. In fact, before we get into our chart, let's play that game right now. Someone give me a chart. Someone give me a time frame. And I will give you both a buying and selling reason, because we can do this at any chart, because our brain can convince us to see whatever it is we want to see. And when we're bouncing around from time frame to time frame, we're doing it with intention. We're doing it because we want to see something specific, and we are just looking for it until we see something that confirms it. Dollar or euro yen 1 hour. All right. Euro yen 1 excuse me, 1 hour. You guys want to start with the buy or the sell? Which one? Which one? You should have picked a hard one. This is an easy one. All right, we'll start with the sell. All right. Price action has come to a previous level of structure support or resistance. Look left. Obviously, we have bearish momentum going down. If we're likely to go down, where are we likely to go to? Right? Our previous outside return somewhere in this area right now. Perfect selling opportunity is to trade it down to this level right here, 135.60s. Right? Pretty simple. Buy, right? Buying is another one as well. Okay, well, we just put in a higher high, higher close above this one. We just broke out of this breakout. This is a potential pullback trade. We're pulling back into a previous level of structure. Buy the dip. Boom. Right? Whatever you want to see, you can convince yourself to see it. And a lot of traders get into trouble because they want to buy something, and lots of the time it's from some other type of confirmation bias, maybe from the news. They don't see a reason to buy on their time frame. So then they start going to these other time frames until they see something that they can make work. They start going lower and lower and lower until they end up on the minute chart and like, oh, there we go. Higher high, higher close. And they get themselves into trouble. So we want to avoid that. So we need to have consistency in what we're looking at. So when we're going through this IPDE process, we want to break up the 4 parts into 2 sections, right? I'm a big believer. You don't have to be like this. It really depends on your strategy. If you're going to be a price action trader, again, it doesn't have to be like this. You can have I'm actually working on a strategy right now that doesn't do higher time frame analysis. By the way, Orsi, I want to show you this before I forget. We were talking about this in the Monday Q&A. Sorry to get off track, but we were going through the strategy development process, and we always start with a baseline, which is really kind of dirty and disgusting and whatnot, and we work on adding filters and doing things to smooth it out. And I want to show you kind of where I showed you this the other day, where I've gotten to. We're getting there. If it loads up, we're getting there. We're smoothing it out. Remember, this part was the choppy drawdown. Then we got it into sideways. We're slanting to the upside, Orsi. We're slowly smoothing this bad boy out before the next pop. Slowly smoothing it out, right? As long as we can get it going in the right direction. Doesn't have to be the big jumps, right? I'm all right with this churn, as long as it's not a downward churn. If it's an upward churn, we're still making progress. It's got a little bit of a bigger dip right here we'd like to smooth out, but we're getting there. We're getting there. I just need to work harder. I know I'm getting there. Hey, I haven't even finished the second pair, so we're gonna get there. Becky says, "Can you please compare the euro yen 4 hour versus the 1 hour?" We can do that later. Yeah, and it's not comparing, right? They're working together. So when we're looking at different time frames, we're not comparing. We're using them together. That's a perfect kind of complement here. So comparing is kind of this versus that. When we use multiple time frame analysis, we want it to work together. We want to form an opinion off of our higher time frame, and then we want our lower time frame to confirm that opinion. Does that make sense, guys? We don't want them working separate. We want them working together. So we don't want to say hourly versus 4 hour or daily versus weekly. We want one to complement another. So when we're doing this IPDE process, if we're using multiple time frame analysis, it could be 2 time frames. It could be 3 time frames. I've never heard of 4 time frames. I suppose it could be as well. Again, it's your trading plan. You can do what you want. In the most cases here, we're going to talk about a 2 or 3 time frame combo, either a higher time frame and a trading time frame, or a higher time frame, a trading time frame, and a lower time frame. You can use those for different things. But we want them to complement each other. So with that IPDE process, right, just as we did in the training yesterday, we want to split up the I, the P. We want to split up the D in the E, right? So identify and predict, what time frame do you think that should be on? Should that be on the higher time frame or the lower time frame? What do you guys think? It should be on the higher time frame, right? The identify and the predict should be on the higher time frame. And the beauty of the higher time frame is this, right? Something that makes trading so hard is the fact that we can essentially always trade, especially if you're trading the Forex market where it's 24 hours. You can literally always trade. And knowing in the back of your mind that we can always be in a trade is very bothersome. You may not feel it, but it does take away from your focus, because there's always this alert that you're in a situation where something like the Bank of England, right? Something like that can happen. So you're not always fully focused. You're kind of always on edge a little bit. The thing about the higher time frame is that you should not be allowed to trade from your higher time frame. I'll say it again. You should not be allowed to trade from your higher time frame. Your higher time frame is only for what? What purpose does it serve? You cannot execute trades from your higher time frame. What purpose does it serve? Strictly analysis. And I can tell you what, when you are doing strictly analysis and you don't have any concerns about trading, it gives you this freedom. It takes away any biases. You're free to operate and see the markets for what they are. So the higher time frame is like our bird's eye perspective. This is us standing on a cliff, looking down at the valley and just getting an overlay of the land. And a few questions we want to ask ourselves are, what is the market doing? What has price done? Where are key levels? Right? What is the market doing? That could be trend. Are we trending? Are we consolidating? Are we in an uptrend? Are we on a downtrend? Right? I mean, I just wrote this in. What is the direction? What has the market done? Have we retraced? Have we put in a fresh breakout? Have we stalled? Where are our key levels of structure, right? Again, for me, structure is a magnet. Structure is the destination. So what levels do I need to pay attention to? What levels are important? And this is going to set up the guideline for the rest of our trade. So we look at the dollar yen right here. Let's take a look at things. And what direction are we trending in? This is the weekly chart. We're going to go weekly, daily for this example. What direction are we trending in? Is the market trending, consolidation? Well, we were in consolidation, right? Down here. We were in consolidation. This little classic pattern, they call this a Greystone special. Greystone loves this. Loves that. Right? We're trending. We're in a bullish trend, right? Where are our key levels of structure? Well, there's not much we can identify here. We see that, well, we had a key level right here that we broke, right? And we retested it right here. Again, resistance turning into support. Ice zone, fishies, animals. Where's our next key level of structure? Okay, well, we had one right here as well. All right, we just broke that. Okay, violated. Where's our next key level of structure, right? Right up here. Would you guys agree? Back in 98. Ooh, what was I doing in 98? High school? First year of high school? Maybe. Right? So we identify our key levels of structure. And we ask ourselves, what is the opportunity? Now, we know that we just DJing. Oh, well, it probably was DJing in 98. No. Too young for that. Nope. Too young for that. Daniel, you hush your mouth, Daniel. You youngsters. You youngsters born with a computer in your hand. Huh. What do you know about the original internet and having to put an AOL disk in and waiting 20 minutes for a website to load up? You don't know nothing about that. What do you know about having minutes for your cell phone and having to tell people call back after 6 because that's the only time it's free? Yeah, you know about that. What do you know about cassette tapes where you got to take the tape out, you got to flip it to the other side and fast forward because there's no rewind button. You don't know nothing about that, youngsters. I'll tell you. What do you know about what were they called? This was the biggest thing back when I was in high school and middle school. Um, the fake pencils that you click with the lead. You got to put the lead in them. What were they called? Gosh, you know what I'm talking about, Charles. I know you know. The pencils, the fake pencils, not the mechanical pencils. Yeah, that was the biggest thing to have a mechanical pencil. I broke them all the time, heavy handed. James said, I had to explain what's. Oh yeah. Well, that's what my kid asked the other day. He said, he's in the car. He's like, what's that mouth in the front of the car? And I'm like, I'm thinking to myself, like, that's a dumb question. Like, that's where you put a CD. And he's like, what's a CD? And I had that old. I pulled over to the side and had an old moment. I'm like, uh, uh, uh. That's when oldness hit me at that very moment. What is that mouth in the front of the car? I'm like, oh, okay, that's whatever, dumb question. That's where you put the CD in, dummy. And then when he said, "What's a CD?" it hit me. I said, he's never experienced a CD before. He's never experienced. Yeah, it's crazy. It's crazy. But anyway, back to whatever. Some of us weren't born the last time yen hit those highs. Some of us was. Yeah, you got to hold that Discman very sturdy so it doesn't skip during your favorite song. Oh yeah, I used to love those days, boy. Anyway, so we know we're in a bullish trend. We know we recently violated a previous level of structure. So now we can start making predictions, right? All we've done is we identified. Have we talked about any type of trade yet? Have we talked about any type of trading scenario yet? No. All we're doing is identifying. And pardon me, you're going to get the lawnmower noise in the background. He does this on purpose. My neighbor knows exactly when I'm doing this live session. He does it on purpose. I know it. Shouldn't have kicked his dog that one time. Anyway, so now we want to make predictions. Okay, well, price is in a bullish trend, right? So we know that price is likely to continue trending until it hits some type of key level of resistance in this case, right? We know that we've just violated the most recent level of resistance. So based on our rules for how we read trend, we can make the prediction that price is likely to continue what direction? Higher or lower? Bigger picture. Because things can go lower before they get higher. We know that. Things can go higher before they get lower. Price is likely to continue higher. So we want to ask ourselves the next question, okay? Because the prediction is a three-part process, right? It is, what is price likely to do? Where is price likely to go? And how is price likely to get there? So we've answered really two of those questions already. What direction is price likely to go in? You guys said higher. Where is price likely to go to? If we go higher, then where is price likely to go to? Well, we've already done that work, right? Remember when next level of structure. We already drew that level out, this little zone right here between these lines. Okay. The next part of the question is, okay, what direction is price likely to go in? Higher. If we go higher, then where are we likely to go higher to? Boom, we got our level up there. Now this one gets a little interesting. If we're likely to go higher to said level, how are we likely to go there? And we can simplify it, and there's only two ways. What are those two ways? What are those two ways? This one's a little bit more confusing, but the answer is a lot more simple than you would think. Yeah, we can go straight up there, or we can pull back and go there, right? The market can just continue with another extension, or we can pull back. Now that seems dumb. Like, why is that worth noting? But it's important because knowing what type of trader we are, that's going to tell us what opportunities we should look for and how we're going to approach the market. So we've gone through the first two steps of our process: identify, predict. Again, Have we talked about trading yet? Have we talked about how to get in? Hey, what's up, Phil? Phil Stewart just came on, checking it out on Facebook live stream. Phil is a great story. Great dude. Phil was a client of mine years back. And I remember Phil told me a year in advance. He says, hey, I'm going to take your course, Akil, next year. And I'm like, you know how many times we hear that? I'm gonna take it next year. He's like, I got to get my situation handled, but I'm going to save up and I'm going to take it next year. And I'm like, okay, yeah, all right, yeah, sure you will. Sure you will, Phil. And in less than a year, right, Phil really got to work on himself. Came back and said, I'm ready, let's go. Before a year was up, and came in and was one of the most dedicated students I've ever worked with. And now is a phenomenal trader and coach in his own right. It's and like, you feel bad, but think about how many people we run into that are like, oh yeah, think about how many friends you have that have these great ideas. I'm gonna do this, I'm gonna do that. Right? We get it all the time. So when someone says, yeah, I'm gonna join next year, it's like, okay, whatever. Yeah, whatever. Sure you are. Not only are most people just not that dedicated, but if people do need to get their financial situation handled, most people don't know how to get their financial situation handled. Most people will just be in a worse situation next year. So it was a pleasant surprise. And when Phil came in, it was full focus. It was full focus. He was there in every session. He was asking tons of questions. I call him one of my annoying clients. Those are the best ones. Jason Greystone was an annoying one as well, because they were just sponges. And no surprise, he became a success. So love it, Phil. I love that you always support. I appreciate it, man. And he's a great coach, not just trading coach, but kind of a mindset and life coach in his own right as well. I appreciate it. But yeah, so we've spoken nothing about trading. All we've done is analysis, right? But by doing that analysis, we've already determined what type of trade we're looking for, right? Are we looking for a bullish or bearish trade here? And again, it can vary depending on your trading style, but based on what we've analyzed here, looking for a bullish trend. So what we've done is we've given ourselves a confirmation bias. Is anyone unfamiliar with the term confirmation bias? I suppose I should explain it anyway, because I know people are watching the recording. But a confirmation bias is basically when you are convinced of doing something for some reason. And there are positive and negative confirmation biases. I'll give you an example of a negative one. So very early on in my investing days, right? This is before I knew what investing and trading actually was. My day, because I had this office in the city, and I had 3 TVs, well, 2 TVs and a laptop, excuse me. And I would watch Bloomberg, I would watch CNBC, and I would watch like CNN. And again, I didn't know what I was doing, but I felt like an investor because I was listening to all these pundits. I had Wall Street journals. I was doing all the stuff that you see in the movies, aside from like the drugs and the wild parties, right? Too expensive. Didn't have enough money back then to do drugs and wild parties. I'd rather invest it. But I would listen to all these people and pundits, and they would all say, like, you know what the headlines are saying, right? Oh, buy gold, buy gold, buy gold, right? Whatever they're yelling at me at the day. So when I went into my investing state looking for opportunities, what do you think I was looking for? Or let's put an example of like let's say buy Microsoft. If all the pundits were screaming buy Microsoft all day, and I start looking for opportunities, and I stumble across Microsoft, do you think I'm looking to buy or sell? I'm looking to buy. Now, why am I looking to buy? Am I looking to buy because I've done my research and I see that it's a good buy? Or is it because subconsciously all these pundits are in my ears telling me buy, 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 buy? So I think that has to be the right thing. Now, these days are different, right? You still have, and you can still watch TV and stuff, but now you've got internet forums. You may be on Twitter, you may be on Instagram, on Snapchat, or in a forum, and everyone's saying, do this, do this, do this. And because 20 people on that forum are saying, do this, you're convinced, because you're the newer trader, you don't have any confidence, you're spineless, right? You're convinced that you have to do it as well. So that is a negative confirmation bias where you've convinced yourself of a certain action because of what you hear or what others have told you. What we've created here is a positive confirmation bias, because now I'm sold on a buying opportunity, but am I sold on a buying opportunity because of the news, because of a scary trading chat room, or is it because of my own analysis? That's a question. Answer it. Answer it. There you go. No, not chat rooms, because of my own analysis. I've created my own confirmation bias based on my analysis. So now when I go down to my lower time frame, and my lower time frame is strictly for trading purposes, right? I've set my trade up already from the higher time frames. The lower time frame is simply saying, okay, well, how can I get involved in this thing? Instead of being blinded and or being confused, because this happens to so many traders, right? Type in a yes real quick if you've ever looked at a chart and you've seen both reasons to buy and sell, and then you've got confused. You ever done that? Like, oh, I can buy right here. Oh, I can sell right there. You freeze up, right? That's called a analysis paralysis. It happens all the time. You're like, ooh, I can buy right here. Ooh, I can sell right there. You sit there, mouth open, drooling on your keyboard. And before you know it, the move happens. I knew I should have bought. Darn it. Right? Of course, you should have bought after it goes up. Right? Hindsight, right? We always should have done that. But we avoid that because now I know that I am only focused on one thing. I am only focused on one side of the market, buy. And that eliminates half the battle, right? If we're wasting half of our energy looking for buy reasons, half of our energy looking for sell reasons, right? We're not giving the market the full attention that we need to give it in order to find good trades. Finding good trades is hard. If we can get rid of one part of that equation, now 100% of our focus is on a particular direction. We can really lock in, refer to our trading plan, of course, to see how we want to get involved. So let's go down to our trading time frame here. Again, we're doing weekly, daily for this example. I'll give a higher time frame example. And we will do euro yen next. We want to make a comparison, and we'll see how the two things work together with euro yen as a request. So we go down to our daily time frame, right? We already know our big picture. We get some other clues here from our lower time frame, right? So we know lower time frame. We came down to this minor level of structure, right? This little ice zone, and we held this level, right? Did we hold or violate? This is a black or white answer. And you guys may not know what violation is. A violation would be a lower low, lower close. So we held. We steamrolled down there, high momentum. Look at these high momentum bearish candles. Closes at least 2 to 3 at the very bottom. Tried to push past that level. Pow! Smacked in the face. Held. Then we get confirmation of that hold yesterday. This is what we were waiting for yesterday. The higher high, higher close. Now, for some, right, this is an entry reason. Now, obviously, you're doing this now. You would have done. We did this analysis yesterday. You would have focused on this analysis yesterday, but this could be an entry reason. So let's say we went through our I process, identify. We went through our P process, predict. The next process is D. So let's say decide, and decide is how are we going to get involved in the trade. Now, this is an easy process because essentially we have to refer to our trading plan. Our trading plan will tell us how we can get involved. Go to your section that says pullback trades. Okay, pullbacks. If RSI goes over, if price action comes back to previous structure, okay, then look for RSI to go oversold. Okay, all right. If we got RSI oversold, then look for higher high, higher close. Okay, we got that. Okay. If we get higher high, higher close, buy next bar market. Pretty straightforward, right? Were there any gray areas in that breakdown? No, pretty straightforward. Why? Because it's in our trading plan. Your trading plan should hold exactly what you need to do in that situation. And if anything doesn't meet those rules, then you don't do it. If everything meets the rules, you do it. If anything doesn't meet the rules, you don't do it. That sums up trading. The problem is most people don't have trading plans, or most people don't have the discipline to follow their trading plan. But there's 3 parts of the decide part, because we need to decide on 3 parts of our trade. There are 3 key moments, right? Entries, stops, and targets. James says, got my trading plan clear enough that I was fully up to speed after 3 years of not looking at a chart. Nice confidence boost. The confidence you feel when you have a fully completed trading plan, and fully completed trading plan is in air quotes because you're always developing it. It's always going to change and morph and adjust as you grow. But you feel unstoppable. There's no nervousness about it. There is still nervousness. There's little nervousness about taking the trade. Less nervousness. But anyway, so there's 3 parts of the trade we want to look at. Entries, stops, and targets, right? We just went through an example of entries. We can give a few more. So this would be an example of an aggressive entry. What would be an example of a more conservative entry? So this is a higher high, higher close. This is an aggressive entry. It's still somewhat conservative. It's the most aggressive I could be in an entry. Speaking of which, while you guys are typing that in, let me just check on dollar Canada action. It's been a rough week for me trading. This is the one that's surviving on me, though. All right. So an example of a conservative entry would be, a more conservative entry would be a double bottom. So we can go back to that process. If price action comes down to previous structure support, then I look for RSI to go oversold. All right. Price action came to structure support. Yep. Look left. There we go. RSI, that's that bad boy down here. Do we go oversold? Yep. Under the 20. Okay. If RSI goes oversold, then look for double bottom, right? So a double bottom would look something like this. If price action comes back to retest this level, and we have strict rules on where it needs to go and what it can or can't do. And you maybe you even add something. If price action gives double bottom, then look for bullish divergence on the RSI. And then boom, that's your entry. Conservative entry right there. Rules base. No ifs, ands, or buts. What would be an example of an even more conservative entry, guys? If someone wanted to be super conservative, a 26.18. If price action comes down to previous level of structure, then look for RSI to go oversold. If RSI goes oversold, then look for retest of structure, aka double bottom. If we get double bottom, then look for bullish divergence on RSI. If we get bullish divergence on RSI, then look for price to violate peak of double bottom. If price action violates peak of double bottom, then look for retracement back to 618, Fibonacci retracement of the double bottom. If price action comes to 618 Fibonacci retracement of double bottom, then enter at market, right? How boring does that sound? But does it not take you through were there any ifs, ands, or buts about that? Were there any gray holes there? It is a flow chart, right? It is mechanical. We are moving from one to the other, right? Step by step process, right? We are robotic and we're just doing this until we get to the point where we can actually execute the trade. And again, if there are any X's in any of these, then is it a trade or no trade? It's no trade, right? This is what we taught you guys yesterday. This is what it looks like in real life. If it's boring, I'm sorry. The truth is, trading is boring because it's mechanical. It can still be fun. I still find lots of fun in analyzing the market. But as far as the actual trading aspect of it, it's pretty boring because I know what I can or can't do. And I sit there and people will get excited and I'll be like, nah, I can't do it. Not yet. I need this. Hasn't done that. Right? But that's how good businesses are run. I don't know how many of you guys are business owners or familiar with business owners, right? Businesses are pretty boring. You can take like a fast food example, right? What do they do in the back? It's like a conveyor belt back there. Or in a restaurant, right? It's a conveyor belt. Everyone has a specific job. You do your job, you pass it to the next person, they do their job. You're not making stuff up on the fly, are you? No. You cook the meat. You warm the bun. You apply the ketchup. You send it out. You give it to the customer. You clean up. You wash the table. And that's how you run an efficient business. The problem is too many traders want the sexy. Too many traders want the sexy. They want the bells and whistles of a casino, right? They want to go in there. They want to bet big money on random things and walk out broke. It's funny because I haven't gambled in a while, but trading significantly helped my gambling. I'm a craps man. Anyone play craps? Any craps players out there? Blackjack's another good example. I wasn't as good at blackjack. I didn't like the pressure of blackjack because I would break the rules sometimes, and the person next to me would get mad and like we get into fights. They're like, "No, well, that should have been my card." I'm like, "Oh no, shouldn't have." But you were supposed to do that. So, but craps is a game of odds, and the thing about craps is this, right? So the casino has the edge in every game in the casino. That's how casinos make money. They're just like traders, right? They have the edge, and their goal is to get as many people in there and staying as long as possible because they will take their money eventually. With craps, basically you get to bet on different numbers, and different numbers have different odds. And then there's these fancy bets where like you win like 30-1, right? You never bet on the fancy bets because if it's 30-1 for a reason, right? It's not really going to hit. You're just wasting money. So beginning of my career, I'd go in on the craps table and just do like I random stuff. Like sometimes I bet a 2, sometimes I bet a 6, sometimes I bet something else, right? I would just lose money all the time. Me and my friend, right? We came up with this strategy. He's a business guy. I was a trader, so we know about risk management. We came into the strategy where we found the numbers with the best odds. And all we did was consistently play the numbers with the best odds. And then when we would collect profit, once we'd cover our bet, then we'd cover the rest of the numbers, eventually covering all the numbers and then hoping for the hot roll. Because the hot roll comes every once in a while, just like the big trade comes. The goal is don't go broke before the hot roll comes. And the casinos hated us. And why do you think they hated us? Because we were betting the right way. And they knew it. They try to convince you, like, hey, you want to do a fire bet, do this, do that. We're like, nah. 468, please. Next round. 468. Next round. Put someone 468 for me. Next round. 468. Next round. Switch it up some. 864, please. Right. And they hated us because but they knew that was a smart way to play. It was methodical, and we did the same thing every time. Darren, they really hated us. You can tell, like you get the looks, and they're like, okay, you guys aren't fun. Yep. But you consistently play the ones with the best odds. You cover your losses, so that's your risk management, your trade management, and then you go for the big win when there's no risk on the table, and then you hope for the big win. And the second lesson we had to learn, without getting too deep into it, is we used to get greedy after the big win. We'd get the big win, it feels good, and then we'd blow it all waiting for the next big win. So we'd spend like 4 hours there, we catch a big win, then blow it all. So then we implemented a rule that said, hey, once we get that big win, and that big win was quantified by a specific percentage of how much we were betting at the time, we just leave. We call it a day. And I remember one time we drove 2 hours to a casino. 2 hours, right? And again, usually we're playing for like 4 hours because it's a game of like make a little bit, give a little bit, make a little bit, break even, whatever like that. We drove 2 hours to this casino, right? 30 minutes in, we hit big. And we just left. We just left. We left. I think we grabbed a bite to eat and then just drove home. And it was weird because like I have a rule where it's like whenever I drive someplace, I need to stay at least the amount of time it takes to drive there. So if I drive 2 hours to someplace, I need to spend at least 2 hours there. But that's when we had become disciplined. Like the job was done. We were in and out the trade in a half an hour. If we stayed, we would have gambled. We would have given it back, no doubt. So we just left, grabbed the bite and left. But trading is the same game. It's slow, it's methodical. You can't give in to, I got to make more. No, get what you came for and get out before you get burnt. Like this market destroys so many people. Do you understand that? 90% of traders fail. Like, do you guys, that is a real number. Some would say that number's low. 90% of traders fail. Like, the odds are not in our favor. We can make them in our favor, but most of them don't. And the reason most of us don't make them in our favor is because we sabotage. And it's usually not even having a good system. It's undisciplined. Not being able to follow our system. Entering too early because we don't want to miss it, right? FOMO, fear of missing out. Entering too late because we don't want to miss it. FOMO, fear of missing out. Not entering something we're supposed to because we're scared. Moving stops back because we're high on the hopium. I hope it'll just reverse in another 50 pips and then I can get out for break even. No, it just ends up taking you out for another 50 pips. Not collecting targets. Seeing a big Bank of England move and saying, oh, I'm going to get all the move. I'm going to get more. And then you wind up missing out on what you were supposed to get in the first place. Like, these are the mistakes that kill traders. Our job is simple, right? Have a plan, execute that plan, and then get out before you get into trouble. Come back another day. This isn't a short-term thing. You're not trading for a week and then retiring. This is a long-term process, right? Come back another day. I'm not sure if Jason shared this story with you, but he had his greatest trading day ever. I think it was like 2 years ago. And then he stopped for like a week because he felt himself ready to do something stupid. He was high on that money, high on that profit. He knew he was going to do something stupid and he knew he was going to give it back. And the smartest thing he did was he just got away from the markets. He left. 90% of traders won't do that. 90% of traders will give it back in the hopes of making more. You made your lifetime best, but it's not good enough. I want to make more. The longer you keep your hand in that cookie jar, the more opportunity you have to get caught. So those are different ways for entries, getting back on topic. We said there were 3 parts that we need to know: entry, stops, and targets. Real quick, there was a question about RSI. Sorry about that. I will go back and answer that. My wife's business is the same way. That's how we're set up. There's a process to everything. Sir, you mentioned RSI divergence and convergence. Can you please explain it better in a chart? Sure. So divergence is when your indicator or oscillator is doing something different than the price chart. So let me see if I can find an example or if there's any good examples here. So here's a good example right here. So we can see the RSI. This is the white squiggly line at the bottom of my screen. This one's a slight one. Let me see if I can find a much clearer one for you guys. A much clearer one. Here's one for you. So you can see clearly here on the price chart, we are making higher highs, correct? Let me know if you guys can see that, the yellow line. Yep. Now we go down to our indicator here, and we are making lower highs. So you can see the indicator and price are doing opposite actions, right? They should be in alignment. Does that make sense? Who asked I can't remember who asked the question. I apologize. But does that make sense? You know me, I'm a dog with a bone. I just want to, you got to type it in and say yes. I'm going to feel bad if you missed it. I'm not sure if you're still in the room. But hopefully that makes sense. That's what we mean by RSI divergence. Perfect. Awesome. All right. So 3 parts of the trade we need to know. Entries. What are the other 2 parts we need to know? EST. Entries, what and what? Entries, blank and blank. You guys on social media, you're getting a bonus session today, which makes me remind you that this is a free workshop, right? Not on social media, but actually over on our platform. So if you would like to, you can still join. It is free. All you have to do is give us an email address. We will give you login information. You can have access to these full live sessions. You can have access to free training. You can have access to software that you can download that will help your trading. Free 99, right? So just do it. It's going to end on the 12th. I'm going to get emails. And I'm going to have to give emails saying it's over, and you're going to be upset. So www.tier1trading.com, get over there, sign up. Everything is recorded, so you can go back and watch whatever you missed. This weekend's a perfect time to do it. Tomorrow's a perfect time to do it, right? Shouldn't be trading during non-farms. Yep. Amanda says, so worth it. It is so. Wait a minute. Is that a backhanded insult, Amanda? It's so worth free? Is that what you're saying? Wait a minute now. It's so worth it. Is that what you're saying? It's only worth free? If you had to pay a penny, it wouldn't be worth it? Huh? I don't know how to take that. That's like when your wife says, I dressed up the other day, and I'm like, hey, babe, I never dress up. Never ever dress up. Dressed up the other day. I'm like, hey, babe, how do I look? She's like, you look cute for you. I'm like, yeah. I had to call up my homie. I was like, hey, your wife ever say you look cute for you? He was like, nah, she just calls me ugly every day. I said, okay, I'll take it as a win then. Okay. Word. You take what you can get. You take what you married 10 years. You take what you can get, right? All right. So entry, stops, and targets. Those are the other things that we need to focus on. Entries, we got that out the way. Again, that's the easy part, is in your trading plan. Stops and targets. Now, stops are pretty easy for me because I'm really consistent with stops. I believe that I do believe in discretionary trading. As a price action trader, you don't have to be that way, but I think there should be a hard set rule on stop losses. And it can take in many things. It can take into account structure. It can take into account even psychological numbers. It can take into account Fibonacci's, ATR, whatever you want to use. It could be indicator based, but there needs to be a hardcore reason on stops. So we're not going to debate all the different ways for stops, but let's say we're using an ATR based stop. ATR is average true range. It's a measure of volatility. Basically, we can look to do a 1 to 2 ATR stop below the lows. So I take my lows right here, 130.40. 130.40. We're not going to do a full lesson on the RSI today. We're going to try and keep this. We're going to try and keep this simple as possible and focus on the concepts that we're talking about during the training. We can talk about RSI and go into detail about it at another time. I'll tell you what, usages of the RSI. Many people only look at overbought and oversold, or even regular divergence. You get to know this tool, this indicator. I guess it is a tool as well. There are many other ways you can use it. I'm a big fan of RSI zones as well. And that goes for any indicator. In general, I would say this to you guys that like indicators. In general, the way that you probably learn how to use an indicator most likely isn't the best way to use that indicator. We'll leave it at that. The way that the popular way you hear about using the indicator, the default settings that are there for the indicator is probably not the most efficient way to use your indicator. You have to be creative. You have to experiment with it and use it in ways that are creative, because creativity is what finds opportunities in the market. But let's say we're going to do a 1 ATR stop. That's going to put our stop loss right. What do we got here? This is 130.40s. So 129.10, somewhere around there is going to be a 1 ATR stop right above 129s. Targets. Now, this is where it's going to get tricky for different people, because different traders trade it differently. If you are a continuation trader, right, you're looking for that higher level of structure that we identified on the weekly that I deleted by accident, right? So you're looking in this zone right here. If you guys remember yesterday, we also put some a Fibonacci there for some confluence. We took a Fibonacci extension from our swing low right here to our swing high, and we found a 127 right at that level, 142.87 with a higher level at our 1618 Fibonacci extension, 147.37. Good levels to shoot for targets. If you are a more conservative trader, right? Where is a place you would probably be interested at taking profits off? What would you guys say? I'll draw out two things, right? Let's pretend we'll draw out a few. We'll do the higher high, higher close of two targets, and then we'll do the double bottom of two targets. So if you're trading for the extension, a true continuation trader, you're looking for an extension to this 127 extension and previous level of structure. Stops are going to be down here. Again, if you're at 129.10, I'd recommend just getting a little bit underneath that 129 even handle. You can afford it. You've got a nice risk reward here, or you can see your risk reward. If you're shooting for a retest of the highs, you're looking for a retest of the highs here. If you're shooting for right below the 129, again, I think you can get right above it. But let's say you're stretching out for a little bit more safety. You still got a nice 1-to-1. Let's say you're someone waiting for a double bottom. And we'll do the two scenarios here as well. Now, we don't know where that double bottom is going to form, but we'll just do kind of a very loose prediction here. Give me a second. But we know that double bottom will probably form somewhere in here. Again, we never know until it actually forms, but let's just make that entry a little bit lower, and we'll get them consistent right in here. And let's just keep the same stop loss for that and look at the different scenarios. So what you're doing is you're measuring your risk reward out, not after you take the trade, but before you take the trade. Now, why is it important to do so before you take the trade and not after? Why is it important to do so before and not after? And just real quick, house cleaning, convergence is when it's not when it's moving, it's not in the downtrend. Necessarily. We're not going to go too much into that, but just I wanted to clear it up a little bit. Becky says to see whether it makes money management sense. Boyd said checks if it's worth it. Know the risk before betting it, so you get out at the right place. Yeah, we want to know our risk profile, right? Because let's say we're in a situation where we have a negative risk profile. And let's say our plan says we have to have 1-to-1. Is this a good trade if our risk profile doesn't meet our rules? And your risk profile could be negative if you want. It could be a 2-to-1. It could be whatever you make it. But if our risk profile doesn't meet our rules, can we take the trade? No. So here's a good example. So let's say I'm entering here late on this higher high, higher close. And I notice that, hey, my risk profile doesn't meet the rules because I require a 1-to-1. What you can then do is go to your secondary option. You can say, okay, higher high, higher close doesn't meet the rule. My secondary entry option is a double bottom. And perhaps that meets the rule. So you can make those adjustments. You don't have to force yourself into a trade that you don't need to be in. You can look at your trading plan and say, okay, entry number 1 is this. If entry number 1 doesn't work for whatever reason, then go to entry number 2. All right. If entry number 2 doesn't work for whatever reason, then go to entry number 3. So you have multiple opportunities to get involved in a trade if you have that solid trading plan. And that's why you continue to develop. So that is the anatomy of a rules-based trading strategy, that IPDE process. Well, the last part, execute the trade, push the button. That's the last part, obviously. But does that make sense, guys, that entire process? We start higher time frame for identify and predict, just observing the market, doing analysis, understanding what the market is doing, what it may or where it may be going next, making those predictions. If we do this, then we're likely to go there. Then once we have that confirmation bias, then we're going down to a lower time frame and we're zooming in, right? We've got the crosshairs out and we're zooming in. We're saying, okay, now that I know which way I want to get involved, now that the market is in my kill zone, what do I need to execute it? And then we're making sure everything else meets the mark. We're making sure the risk profile is in our favor. And if it is, then we're waiting for the thing to happen so we can pull the trigger. If it isn't, then we can go to plan B or plan C. But it is all a process, right? Was there any thinking? Was there any hoping? Was there any randomness in that process? Or was it all smoothly drawn out? It was smoothly drawn out. And that's how businesses survive. Businesses that do things on the fly do not survive. Businesses that have a thought out, executed process that has been tested and confirmed for profitability, those businesses survive. And they're always adapting. Don't get me wrong, right? We're always adapting and adjusting as traders, but we're sticking to a consistent process because consistent analysis plus consistent execution brings consistent profits. Get it? Perfect. All right, let's take our first break. We're an hour in already. We'll let that marinate. We'll come back. I haven't forgot about Euro Yen. I think it was Amanda or Becky, one of them, wanted to take a look at Euro Yen, do some analysis there. So I'll put 13 minutes on the clock for you guys watching on social media. Thank you for joining. Remember, tier1trading.com. Sign up for the workshop. It's free. Got cool stuff. And Amanda said it's worth the freeness. So take her word for it. But yeah, put 13 minutes on the clock, and I'll see you guys in a little bit.